Hi, welcome to the International Financial Management class. This topic belongs to BCom students for 5th SEM, Bangalore North University, um, session 18. The topic is Capital Budgeting Techniques. Recap of the previous class. In last PPT, we had discussed about introduction to concept of investment appraisal and its scope and factors affecting capital investment decisions. Learning objectives. To understand the various techniques of investment appraisal, its merits, demerits, etc. Session outcomes. Students will have knowledge about the various techniques of investment appraisal, its merits and demerits. Various techniques of investment appraisal. First one, payback period. Second one, accounting rate of return. Third one, net present value method. Fourth one, internal rate of return. Fifth one, profitability index. First one, payback period method. So payback period means the time taken by the business or project to recover the initial investment or the cost, that is known as payback period. The time taken by company to recover its initial cost, its investment. So merits. It is a traditional and old method. It is a simple method. The selection or rejection of the project can be made easily. The results obtained under this method is more reliable. It is best method for evaluating high risk projects. Demerits. It is based on the principle of rule of thumb. It does not recognize the importance of time value of money. It does not consider the profitability of economic life of the project. That means it never consider the profits after its payback period. It does not recognize the pattern of cash flows and its timing. Payback period concept does not reflect all the relevant dimensions of profitability. Second method is technique is accounting rate of return ARR. So it considers the earnings of the project of the economic life. So in payback period the pro it only considers payback period. Once the business recovers its initial cost and the time taken, after that it never considers, but here it considers the profits of entire life of the project. The rate of return is expressed as a percentage of earnings of the investment in particular project. Merits. It is very simple to understand and use. This method takes into account saving over the entire economic life of the project. Therefore, it provides a better measure of comparison of project than the payback period. This method, through the concept of net earnings, ensures a compensation of expected profitability of the projects, and it can readily be calculated by using the accounting data. Demerits. It ignores time value of money. It does not consider the length of life of the project. It not consistent with the firm's objective of maximizing the market value of shares. It ignores the fact that the profits earned can be reinvested. Next, the third one, net present value method. Here, in which the cash inflow are compared with the cash outflow or original investment. If we get either we get positive value or negative value, that difference itself known as net present value. So the advantages of this method is given below. It recognizes the time value of money. It considers the cash flow of the entire project. It estimates the present value of their cash inflows by using discount rate equal to the cost of capital. It is consistent with the objective of maximizing the welfare of owners. Demerits. NPV, this method is based on discount rate. In real life situation, it is difficult to find and understand the concept of cost of capital. It may not give reliable answers when dealing with alternative projects under the conditions of unequal lives of the project. Decision arrived at may not be satisfactory, and when the project being compared involve different amount of investment. Next method is technique is internal rate of return method. In this method, it is a rate. Internal rate of return is a rate at which the sum of discounted cash inflows are equal to sum of discounted cash outflows. So the merits of this method is given below. It considers time value of money. Calculation of cost of capital is not a prerequisite for adopting IRR. IRR attempts to find the maximum rate of interest at which funds invested in the project would be repaid out of the cash inflows arising from the project. It is not in conflict with the concept of maximizing the welfare of the equity shareholders. It considers cash inflows throughout the life of the project. Demerits. Computation of IRR is tedious and difficult to understand. This method is more reliable than IRR for ranking two or more projects. It may give results inconsistent with the NPV method. Next, fifth one, profitability index. It give it gives relationship between net cash inflows and present value of cash outflows. It provides ready comparison between different investment proposals. Projects having highest profitability index will be ranked highest and vice versa. The advantages are given below. Closely related to NPV, generally leading to identical decisions. Easy to understand and communicate. May be useful when available investment funds are limited. Disadvantages may lead to incorrect decisions in comparisons of mutually exclusive investment. Make or buy decision is a judgment made by management whether to make a component internally or buy it from the market. While making decision, both qualitative and quantitative factors must be considered. Examples of the qualitative factors in a make or buy decision include control over quality of the component, reliability of suppliers, impact of the decisions on suppliers. The quantitative factors are actually the incremental costs resulting from making or buying the component. For example, incremental production cost per unit, purchase cost per unit, production capacity available to manufacture the component. Lease or buy decision. Lease or buy decision involves applying capital budgeting principles to identify if leasing as asset is better option than buying it. Leasing in a contractual arrangement in which company obtains an asset from another company against periodic payments of lease rentals. It may typically also involve an option to transfer the ownership of the asset to the lessee at the end of the lease. Buying the asset involves purchase of the asset with company's own funds or arranging a loan to finance the project. Multiple choice questions. Which of the following statement concerning the payback period is not true? It is simple. Calculate, understand. Payback period measures time that project will take to generate enough cash flows to cover the initial investment. The payback period ignores cash flows after payback point. It takes account the time value of money. The correct answer is it takes account the time value of money. ARR, accounting rate of return, is measured as follows. Accounting rate of return, the correct answer is annual profit. Average annual profit expressed as a percentage of average funds invested in the project. Net present value is, the correct answer is present value of expected cash inflows less presented values of cash outflows. Internal rate of return is, the answer is rate of discount at which present value of future benefits are equal to cost of the project. Profitability index, the correct answer is present value of inflows to present value of cash outflows. Reference. This PPT was the content of this PPT is getting from International Financial Management, New Delhi, Himalaya Publishing House. Author was is Dr. Goswami Cotton. Also, this content was drawn from Financial Management, Radio Himalaya Publishing House. Thank you, one and all.